Hi, everybody. Dean Rocco here, and we're excited to bring you a program provided by the Insurance Board on the CARES Act and all of its implications for employers in the coming weeks and months as they respond to the coronavirus pandemic. I'm very happy to be here. I want to thank Insurance Board for inviting me to be here. A little bit about myself. I'm a labor and employment lawyer by trade. I'm sitting and coming to you live from my home in Los Angeles, California, subject to a stay-at-home order myself, as many of you probably are that are watching this. And before we jump into the program, just wanted to point a couple things out in terms of housekeeping. You'll see a chat bar to the side of the screen. We want everybody to feel welcome to post whatever questions that they might have as we're going through the program. We'll try to get it to as many of those questions as we can. To help us out, please let us know what organization and what state you're posting from so that we can try to be direct in our responses. And then also for those of you that are watching, taking some notes, don't feel too anxious if you're not able to take down everything that we say. The program itself will be recorded and will be made available by the Insurance Board afterwards. So you can go back and take a look at slides or some of the content if you missed something. With all that said, let's jump right into the program. Today, we're talking about the CARES Act. It's an acronym that stands for the Coronavirus Aid, Relief, and Economic Security Act. It was just passed into law by the House of Representatives after coming out of the Senate, and President Trump immediately signed it into law. The act is a gigantic statute. It provides over $2 trillion in relief to address the expected economic impacts of the COVID-19 pandemic. And it's about 900 pages long. So I'm going to try to distill it in a way today that is user-friendly, is engaging, and doesn't put anybody to sleep like it will do undoubtedly if you try to read this book. The funds that are outlined in the CARES Act are earmarked to go out into a myriad of ways. And the point of today's discussion is to really look at those provisions that are going to impact how American companies structure their workforce and treat their workers in the coming weeks and months as they try to adjust themselves and their business practices to the economic impacts of this coronavirus. Just really quickly from 10,000 feet, we're going to be talking about the Paycheck Protection Program. That's about $350 billion worth of federal funding that's being made available for businesses to cover certain expenses, most notably payroll expenses, and in what amounts to free money if it's done correctly and a company follows the guidelines. The loans that are going to be going out for the companies under the Paycheck Protection Program are completely forgivable by the federal government if they're used correctly. So it's an amazing program for companies that are struggling to figure out how they're going to continue doing operations in the coming weeks. The act also makes available about $10 billion in economic injury disaster loans. These are not new products or new creatures. These are things that you'll see in the wake of things like hurricanes or natural disasters. It'll expand those programs, make those loans available to small businesses on some pretty favorable terms. They won't be forgivable, but you'll, as we'll talk about, you can get an advance of about $10,000 on those loans, which if you're provided those advances, those need not be repaid. The act also does a lot with respect to unemployment benefits and really expands what states are able to do with the federal funding that they're going to get to supplement their state programs. There's a pandemic unemployment assistance program that's going to provide individuals that are negatively impacted by COVID-19 for up to 39 weeks of unemployment benefits. And those benefits would be available to folks even if they otherwise wouldn't be available or eligible for unemployment benefits under state programs. There's also a pandemic unemployment compensation program, which gives individual workers $600 in weekly benefits on top of what they would already get from their state programs. It further allows states to waive waiting periods so that they can start providing and funding benefits to individuals immediately. And it also applies an additional 13 weeks of unemployment benefits to what states were already providing under their state programs. And in addition to doing all of that, there's some additional support for work share programs. We'll talk about them in a little bit. But those are programs where employers can cut employee hours and pay in lieu of just entirely laying them off, and then using employment or unemployment benefits to make up some of the shortfall. The Act does a lot of other stuff. Most people that you hear about on the news talking about this CARES Act are going to be talking about the stimulus payments or rebates that are coming out to individuals. We won't spend a lot of time on those today, but we will talk about them just so you can understand what your workers are getting. But beyond those payments that are going directly to Americans, the Act's going to allow employees to make early withdrawals or increased amounts of loans from their 401ks, IRA accounts, or other qualified retirement plans, which you may be involved in some level of administration. So we'll talk about that as well. And then there's also going to be employment tax credits for employers who are negatively impacted by the COVID-19 pandemic. So we'll talk about what that all looks like. And then there's some smaller items that won't require as much time to talk about, but they're very important for employers, including employers deferring their payment of Social Security taxes on employment taxes, and the new approach for employers to get expedited refunds for the benefits that they're paying under the Families First Act, which came out a week before the CARES Act, which provides paid emergency, sick, and family leave time to individuals that are impacted by the coronavirus. So we'll talk about all of that in more detail, but that's sort of what we're going to get through in today's program. So let's talk about this Paycheck Protection Program first. It is really a unique program, nothing that some of us have ever seen in our lifetime, and it's a little bit hyperbole to say it's free money, but as we'll discuss now, if you get the loans for the right reasons and you use them correctly, effectively it will be a completely 100% forgiven loan for an employer to be able to cover their payroll and some other costs in the coming 2 months or so. So the Act, as I mentioned before, provides about $350 billion in SBA 7A loans, for those of you that are familiar with what those are. These are loans that are funded by or backed by the federal government, but they're made available to the private sector through banking institutions. Those loans will be 100% guaranteed by the federal government, and they'll be available starting February 15th and running through June 30th, although you're not going to be able to apply for them until April 1st if you're a business, or April 10th if you're a sole practitioner or an independent contractor. If you want to get one of these loans, you'll go to a SBA lender or another lending institution, a third-party lending institution that is authorized to make these loans. Those would include federally insured depository institutions, federally insured credit unions, and farm credit system institutions. So if you have a banking relationship, your bank likely can get access to these sort of loans. There's already a loan application posted by the Department of Treasury. So if you want to start gathering information now and getting ahead of the curve, go to the Department of Treasury, look for their COVID response pages and resource pages, and pretty predominantly you'll see the loan application there, and start working with your banker to pull that all together. The loans are generally going to be available for businesses and 501c3s that have fewer than 500 employees. Now, the SBA defines some small businesses based upon their size in their industry, and some of those businesses might have more than 500 employees, and they'll still qualify for these loans. But I think for the lion's share of the folks that are viewing today's program, that 500 number is going to be something to sort of really focus on. If you have more than 500 employees in your organization, don't give up. I would still check with your in-house counsel or your lawyers or a consultant and see if you don't fit some of the different exceptions to that rule. For those of you that might have side businesses or loved ones that are carrying on a business, these loans are also available to sole practitioners or sole proprietors and independent contractors. Any business that wants to take advantage of these must have been in operation before February 15th, 2020. The application process is not entirely onerous. You're going to have to certify that the loan is necessitated by current economic pressures, that the funds are going to be used to retain workers or maintain payroll, make mortgage, lease, or utility payments, and that you haven't already applied for a similar type of 7A loan through the SBA program. The available loan amounts are a little bit tricky, not entirely complicated, but they're basically 2.5 times an applicant's defined monthly payroll costs, up to a maximum of $10 million. So if you've been in business for quite some time, what the law will generally do is average your monthly payroll across the prior year and then allow you to multiply that by a factor of 2.5 times. If you're a newer business or a newer division of an organization, the loan institution is going to take January and February payroll, average those, and then apply the multiplier. When you're looking at what your payroll costs are, it's a pretty broad definition. It'll include all of the traditional forms of salaries and commissions and wages. It'll also include benefits, employee benefits, and some state and local payroll taxes. So you'll be able to capture all of that and get a loan out to cover those amounts. Important to note, the payroll costs only cover the first $100,000 of an employee's compensation. So if you have highly compensated individuals, you're only going to effectively be able to take a loan to pay the first $100,000 of their salaries. It also does not apply to employees that are located outside the U.S. And if you're applying for the loan in the coming days and weeks, and over that time period, you've been paying out some of the Family First paid sick and family leave under that Emergency Act, those amounts wouldn't be factored into your payroll costs under the law. In addition to, once you get the funds, in addition to making some basic payments for your business like mortgage or rent or utility payments, you can use the loan to pay those very same defined payroll costs. So the employees' wages, their salaries or their commissions, and also their paid time off benefits and healthcare benefits. Again, compensation would be limited, and you could only use the loans to pay up to the $100,000 limit for any one particular employee, and you couldn't use the money to pay for people that are residing outside of the U.S. or for those benefits under the Family First Response Act paid family and sick leave programs. So let's talk about the big ticket item here on the Paycheck Protection Program, which is the loan forgiveness piece of it. The loan that you obtain through the Paycheck program will be forgiven in an amount that's equal to what you as a borrower spend during the 8 weeks following that loan's origination on payroll costs, mortgage and rent, or utility payments. Now, the Department of Treasury has put out some guidance on this, and that guidance suggests that they're going to provide forgiveness for payroll to the extent that it's representing 75% of the amounts that are being spent. So my recommendation would be keep an eye on that guidance, make sure that you are predominantly using this for payroll. That's why this act was passed. The government wants people to stay in business and to continue to pay their employees to the extent that they can. If you do that, the loan will be forgiven for that amount. So if you take out $100,000 and you spend it on those amounts over that 8-week period that we're all starting to go into, and you get to the end of the loan and you pay back whatever you don't use or use the entire $100,000 amount, that loan can be forgiven and you don't have anything sitting there at the end of the day. In that respect, it is sort of free money, to use that expression. Now, there is a wrinkle here. Loan forgiveness is going to be reduced proportionately based on any reduction that you make in your workforce or your workforce's salary. So you look at the year prior and determine whether or not your workforce has been cut at all, or your employees' wages have been dropped below 25% of what they made in the year prior. And we have a little slide here to show you how this really looks. But effectively, if you take that head count and you can create a percentage of what it was versus what it became. That will be a percentage reduction in what your employee headcount was. If you take salaries and you drop them below 25%, you take that percentage drop of salary pay, and that will be how your loan forgiveness is impacted. Now, some of you, by the time that you hear this message or you decide to roll out these programs, will already have made cuts. You might have furloughed some workers. You might have had to cut some employees' pay. You might have become subject to some stay-at-home orders. You weren't sure how to respond to them quite yet, and you sent people home. Don't worry. If you've already furloughed workers or laid workers off or cut salaries, you can reverse those decisions by June 30th of this year and still be able to enjoy full loan forgiveness. You just need to make that change and then roll it out and then apply the proceeds of the loan, and you should be in good shape. So don't fret if you've already sort of taken steps that you might think would negatively impact your ability to get loan forgiveness. Beyond being forgivable and beyond having fairly low interest rates, the interest rates on these loans go up to 4%. The loan themselves, if you have a balance at the end of the forgiveness calculation, it's deferrable for up to 6 months interest free. So again, it gives employers a really good opportunity to stay afloat, to pay employees, to keep the lights on. And then if you do have a balance due at the end of this, you have some time to catch up, get ramped up, and then start making some of those payments. That's really the Paycheck Protection Program in a nutshell. Let's also talk about the emergency EIDL grants that are being made available through the SBA. These are separate loans that are being made available to small businesses. There's up to $10 billion currently that's available for these sort of loans. As I mentioned before, these are not unique creatures or something that was created whole cloth in response to the pandemic, but it buttresses existing programs and makes more funds available and loosens up some of the restrictions for small businesses that are trying to seek these sorts of grants. Unlike the Paycheck Protection Program loans, where you'll be going to your traditional lending partners, these grants are going to be given out directly by the SBA. So you'll go right to their website, look right for their COVID programming, and you'll be able to find out how and where you can apply for these sort of grants. The grants themselves are capped at $2 million. These loans are capped at $2 million. Unless a business is a major source of employment, they may consider providing you more. The amount of the loan is tied to the substantial economic injury that a business has suffered as a result of COVID-19 related economic downturns. And all of that will be factored into the grant or loan application process. The loan interest rates on these program grants are up to 4%, but they might be lower depending on what the SBA provides in terms of its rate structure at the time of the application. So again, that's something that you'll just find out when you go to the SBA and apply for them. The businesses that are going to be eligible for these are going to mirror a lot of what I already said about the Paycheck Protection Act or Paycheck Protection Program grants. It's traditionally or generally going to be employers that have 500 or fewer employees, with some exceptions. The EIDL grants, or the emergency or the economic injury disaster loans, can be used for a variety of things, but principally the Treasury wants these being used for payroll, providing sick leave to workers, making mortgage or rent or utility payments. And if you have increased costs in your supply chain because it's disrupted and it becomes more expensive for you to get the goods to operate your business, to cover some of those as well. Now, one of the interesting wrinkles here, these loans are favorable. They're on favorable terms to small businesses, but they're not forgivable. But if you apply for one of these grants, you can ask for up to a $10,000 advance, and it's at least in the wording of the statute, we'll see how it works in practice, but on the wording of the statutes, it's automatic. And you'll receive it within 3 days of the request for the advance. That $10,000 can be used for providing all of the things that I just talked about. And the advance does not need to be repaid, even if you're ultimately denied the SBA EIDL loan. Now, if you get denied that sort of a loan and you then make it a loan under the Paycheck Protection Program, that $10,000 would come out from what would be otherwise available to you as a loan. And it's already been forgiven, so it wouldn't be subject to forgiveness. But that's another way for employers that are facing some tough economic conditions to go out, find some funding to help them cover themselves in the coming weeks and months, and get a $10,000 essentially forgivable or non-repayable advance to cover some of those core business costs for your organization. So we've now talked about the loans or the grants that are available to businesses to help them cover their payroll costs and some of the core business expenses in the coming weeks and months. I wanted to spend some time now and talk about the unemployment benefits that are going to be made available through the CARES Act, the expanded unemployment benefits that are going to be made available. And it's really important, even though you're not going to be administering these benefits, the states will be doing that through your state agencies. You really need to be educated about what these are for a couple of reasons, two that really principally come to mind. One, your employees are going to be asking you about these things, and you're going to need to be able to have an intelligent conversation with them, provide them the notices that are required under your state laws, and to the extent that they have a loss of employment or underemployment, send them to the agencies to get these sort of benefits. But beyond that, if you're looking at your workforce and figuring out, what you have to do, if you have to make cuts, how this is all going to really factor in, whether you'll keep people potentially a little bit underemployed and use a work share program or the like to try to retain people without completely laying off your staff, you're going to want to know how much unemployment insurance is out there for folks. How long will they be out? How much will they be receiving? Understand that from a general standpoint, the CARES Act is not only going to expand the length of time that you could have somebody on unemployment, but also the amount of benefits that they would receive. So let's get into it and really talk about some of those details. First, there's a program, it's referenced as the Pandemic Unemployment Assistance Program, and that part of the CARES Act extends up to 39 weeks of unemployment benefits to individuals who wouldn't necessarily even be eligible for unemployment benefits, or who would have otherwise exhausted their right to stay on unemployment benefits, who are otherwise able to work and available to work, but are unemployed or partially unemployed or unable to work because of COVID-19. Now, there's a laundry list of factors of what would keep somebody out of work related to COVID-19. Let's take a look at a couple of those just so that you can have those in mind. The first would be if the individual themselves has COVID-19, or if they have symptoms and are seeking a diagnosis from a healthcare provider. Those sort of persons would be eligible for this unemployment benefit for the period of unemployment. If they've got a family member that's been diagnosed, or they're providing care to a family member or a member of their household who has COVID-19. If they have a child whose school or daycare has closed because of COVID-19 public health emergencies, and they're unable to work because they have to care for that child, they'd be eligible for this new unemployment benefit. If they physically can't get to work because of a quarantine, if the government says you're sheltered in place, we sort of want you to be at home. If you're an essential business, you can go to work. If they say stay at home or you can't come out of your house today, then the unemployment benefits will become available. If they have a healthcare provider that tells them you're sick or you're predisposed, and I as your healthcare provider, I'm ordering you not to leave your home, that would also qualify as an individual that could be eligible for these benefits. By the way, for those of you that are familiar with the Families First Act and some of the paid sick and emergency leave benefits that are provided in that statute, these sound familiar, right? These are a lot of the same sort of things that are going to be triggering benefits under those sort of statutes as well. So there's going to be some coordination here that you have to be aware of. If they're scheduled to start a job, if they got a job offer, say in January, they're going to be starting in February, and things have happened since and they're unable to go to that job, those people would be eligible for unemployment benefits under this program. If there's been an unfortunate death in the family and an individual's moving into a head of household position because of their spouse passing away, they would have the ability to get these unemployment benefits. And if they had a job that they had to quit, or they can't go to work because the workplace is closed, all of those reasons would be triggering events for unemployment benefits under this pandemic unemployment part of the CARES Act. Notably, these benefits are also available to self-employed independent contractors and other persons who may not have a sufficient work history to otherwise qualify for state unemployment benefits. Now, the interesting thing here is the benefits are going to track what normally would be an eligible unemployment benefit amount under your state's program. But in addition to that, an individual would be able to get an additional $600 per week. Remember that number, we're going to talk about it in a second as well. The payments can run retroactively starting January 27th of 2020 and run through the end of 2020. An individual who teleworks or is getting paid to telework, or is receiving paid emergency family leave or sick leave under the Families First Coronavirus Response Act that I was just mentioning, those individuals won't be able to get unemployment while they're being paid to telework or receiving those paid leave benefits. But when they exhaust those, or if their employment status changes because of the factors that we just ran through, they would trigger eligibility under these unemployment benefit programs. The CARES Act also announced a pandemic unemployment compensation program where individuals who are otherwise receiving state unemployment benefits are going to get an additional $600 per week through July 31st, 2020. Period. Stop. That's the end of it. Now, there's nothing in the law that says if that $600 puts them over what they otherwise would have been paid, there's an offset. It's just $600, an additional lump sum that the federal government is providing and funding for states to then trickle back down and get to their employees. There's some administrative steps in terms of how states will do that. Will they put it all in the same check? Will they split it out? That won't be your headache, but just understand that when you're factoring in, I don't want to put my employees on the street, or I don't want them to be underemployed. And even if I give them, or even if they're eligible for unemployment benefits, they're only going to get a percentage of what they otherwise would have made. Understand that they're now going to get an additional $600 per week in their paycheck beyond what they otherwise would have received. The other sort of interesting thing that happens here, there's mention of this in the Families First Act with respect to some of the emergency sick and emergency family leave programs. But the CARES Act makes specific reference to states being able to waive any week waiting periods under their programs. And the states will now be able to receive funding from the federal government to provide immediate benefits from day one of an individual being qualified for unemployment benefits in your state. So there will not be a week of period where an individual will be on unpaid leave or not able to get unemployment benefits. From day one, they'll be able to get those if your state adopts those programs and plugs into those federal funds. In addition to giving folks $600 on top of what they otherwise would have received under traditional state unemployment claims, the emergency unemployment compensation provisions of the CARES Act also extend the maximum length of an unemployment claim by 13 weeks. And these 13 weeks can go all the way up through December 31, 2020. Those additional 13 weeks of benefits would be available for folks who are able to work and available to work, but are actively seeking work and have not found employment. Those are calculated similar to how this new construct looks. You'll have the traditional state unemployment benefit amount plus the $600 extending out for 13 weeks. Now, I've mentioned during this program already work share programs. For those of you that are not familiar with them, a number of states, I think it's a little more than half of our states, adopt work share programs where employers, rather than laying off an entire workforce, can find ways to share the work that's available for employees, cut hours, reduce and have a commensurate reductions in pay, but keep people employed. And then those individuals can go to their state unemployment agencies and say, hey, I used to make X dollars, now I'm only making Y dollars, and I'd like to apply for state unemployment benefits to help me make up that difference. The federal government through the CARES Act provides additional funds and resources that were already coming in through the Families First Act to buttress and provide funding for those sort of programs. If you're curious about those, beyond going to your consultants or in-house attorneys or outside lawyers, look at your state employment development agencies. They all have different names and acronyms, but if you have those programs available, most of them are pretty good about providing the criteria and what you have to go through to apply for and participate in those sort of programs to keep those workers employed, albeit underemployed, while making up some of the difference through some unemployment benefits contemporaneously. That's really the nutshell of what's happening from an unemployment benefit aspect on the CARES Act. Before we close for today, I wanted to go through some of the other rebates or tax credits that are built into the CARES Act that are generally applicable to employers and the folks on today's webinar, so they understand what those look like and make sure that you're absolutely taking advantage of them. First, everybody's heard about this notion that folks are getting checks from the federal government, more free money, as it were. That's not necessarily the case, but it's probably worth discussing because for those of you that are trying to figure out how to work with your workforce, make sure that they can still make ends meet, you definitely want to understand, generally speaking, what is coming into many taxpayers' mailboxes. Individual taxpayers, or some individual taxpayers, are going to receive stimulus checks, which are couched as rebates or credits against 2020 taxes, but largely are going to be free money, based upon their adjusted gross income for 2019. Now, for those people that are taking advantage of all of these extensions through June and July under state and federal tax laws, the federal government's going to look at what information they have on 2018 returns to calculate these rebates. Individuals who have an adjusted gross income below $75,000, or head of household filers who have adjusted gross income below $112,500, are going to receive $1,200 checks. Married couples that are filing jointly with an adjusted gross income below $150,000 are going to receive a check for $2,400, which is just $1,200 times two people. Certain parents of children under 17 are going to receive $500 additional per child. Now, these rebates are going to phase out for every $5, or I should say the reduced $5 for every $100 an individual exceeds those thresholds. And they'll completely phase out for single filers once they get to $99,000, head of household filers once they hit $146,500, and joint filers with no children at $198,000. There's a number of criteria. Folks are going to have been filing taxes, have Social Security numbers, and sort of be in the system to be having the IRS and Department of Treasury calculating these numbers and sending out checks. All interesting to note for some of you on the phone call, you may be taking furious notes and getting ready to receive a check. That's all good, but for the employers on the call, understand that beyond giving folks these rebate or stimulus checks, the federal government is going to loosen the restrictions and the loan amounts that individuals can pull out of 401k plans or IRA accounts, or loan from qualified benefit plans in the coming weeks to sort of bridge whatever financial circumstances they may be facing. First, though, for folks sort of pulling out money early from 401k plans, or IRA accounts, they can pull up to $100,000 without incurring the 10% penalty for in-service distributions. Now, to do that, they have to certify that they or their spouse or a dependent has been diagnosed with SARS or COVID-19 or otherwise experiencing the financial downturn or consequences of being quarantined, furloughed, or laid off due to COVID-19, or otherwise unavailable to work because of a work closure or some of the school or daycare closures that we've been talking about. So individuals can pay the taxes that otherwise would be due on those distributions over a 3-year period ending in 2022. Alternatively, if an individual takes that money out and then repays it into their plan by that date at the end of 2022, they can avoid the taxation altogether. So it ends up being a bit of a loan from those programs. Now, speaking of loans, persons can also draw increased loans from their qualified retirement plans through the end of 2020. Those loans can be up to $100,000, which is an extension or expansion from the traditional limit of $50,000. And the loans can be repaid over a 6-year period. And the repayment period for an outstanding loan that already existed before the CARES Act is now told through December 31st, 2020. So if you were already taking money out of a qualified retirement plan and you had to pay it back, you can extend the repayment period out through the end of this year. Moving away from those employee loans or withdrawals from their retirement plans, I wanted to mention another one of the pieces of the CARES Act that is generally applicable to employers, and that is payments of student loans. If you already have a program or might consider rolling out a program to help your employees in the coming days, weeks, you can pay up to $5,250 of an employee's outstanding student loans, and that payment is going to be seen as tax-free to the employee through the end of 2020. So it's a little bit of a fringe benefit that you might be able to provide. I'd advise you to talk with your tax advisors and consultants to see if there's any benefit to the organization to doing it as well. Maybe that's something that you roll out and help employees in the coming days and weeks. Moving beyond that, the Act provides an employee retention credit for employers that are negatively impacted by the COVID-19 pandemic. Eligible employers are going to be those that were carrying on a business in 2020, which had to fully or partially suspend their operation due to governmental orders limiting commerce, travel, or group meetings, or whose gross receipts are 50% less than their gross receipts for the same quarter of the prior year. And once they hit that point, they will continue to be eligible for this tax credit until their receipts improve, I guess, for lack of a better word, and reach 80% of their gross receipts for the same quarter in the prior year. This tax credit applies against employment taxes, and it will equal 50% of the qualified wages that you are paying for each employee between March 13th, 2020 of this year and December 31, 2020 at the end of the year. Now, for employers that have 100 or less employees, all wages paid will qualify for the credit, and you'll take 50% of them. For employers that have more than 100 employees, qualified wages are only going to be those paid to employees who are not providing services due to the suspension of the business or the drop in gross receipts. Qualified health plan expenses are included in the wages or the payroll costs that you're looking at when you're calculating these payroll tax credits. The amount of qualified wages for each employee for any quarter may not exceed $10,000. And wages taken into account for emergency family or emergency sick leave under the Family First Act are not included in the qualified wages for which you'd be calculating and receiving a tax credit. Additionally, employers should be aware that you can defer your payment of your employer's share of Social Security taxes on employee wages. Those can be deferred up to 2 years, and your first payment is not due until the end of 2021. So whatever the amounts would be, you can defer them, cut them in half, pay half at the end of 2021, and pay the other half December 31st, 2022. Again, it's another way for you to carry, keep cash on hand, use it for the going concern, and defer those payments to the federal government to the months and years ahead when things improve and you come out from some of these grayer or darker clouds. And finally, I wanted to talk about one of the Act's provisions, which ties back again to the Families First Act that was also just recently announced. If you recall, employers are able to take the amounts that they pay under the emergency paid sick leave and the emergency paid family leave provisions and essentially refund those to themselves or get them repaid by the federal government by first looking at their quarterly payroll tax payments. And if they had an amount that was owed, they could take out the amount of any payments that they made in the emergency paid sick or family benefits from those amounts and keep them. For some employers, you might actually end up with a refund and you would otherwise have to wait till the end of the tax year to get that. The CARES Act allows an immediate avenue for employers to go out and file a form. It's the IRS just rolled it out. I think it's Form 7200. And that form will allow you to apply to the federal government, say, hey, you owe me some money that I've already paid to employees, and get that money directly back, quickly back into your organization to use for capital. To give an example, and these are numbers just sort of made up nice and round so that you can demonstrate the point, but let's say you paid out $10,000 in a particular quarter for paid emergency sick leave under the Families First Act. And then you go to file your quarterly tax returns and you owe $12,000 to the federal government payroll taxes. Well, you've paid 10 out, you owe 12, you just write a check for $2,000, send that to the federal government, and you're square. That is something that didn't really change with the CARES Act. But let's say you paid the $10,000 out and you only owe $8,000 in payroll taxes. So the federal government owes you $2,000 to repay what's been paid out in those emergency sick or family leave payments. That's where you would use the CARES Act news provision and the Form 7200 to go to the Department of Treasury and say, hey, here's what I've overpaid. Get that money back to me as quickly as I can so I can use that to continue my business operations in the weeks ahead. Hey everybody, as a quick epilogue to our review of the CARES Act, we wanted to address some of the issues that were quickly evolving as we put this program together, and also spend a few moments going through a roadmap for how you can pursue these loans, and in particular, the Paycheck Protection Program's potentially forgivable loans. First, we wanted to reiterate that the Paycheck Protection Program is open to religious institutions. The terms of the CARES Act itself and subsequent interim rules, as well as the specific faith-based organization frequently asked questions sheet that the SBA put out, make absolutely clear that religious organizations and churches are eligible for this relief. The Paycheck Protection Program's loans available through the SBA are unique in this regard, and several other aspects. The guidance clarifies that your organization does not need to apply for or wait for its confirmation of tax-exempt status to receive a Paycheck Protection Program loan. You simply need to meet the requirements otherwise of Section 501c3 of the Internal Revenue Code and the other CARES Act requirements. The guidance further clarifies that organizations will not sacrifice their autonomy, their First Amendment, or statutory rights if they receive this funding. In the words of the SBA, simply put, a faith-based organization that receives a loan will retain its independence, autonomy, right of expression, religious character, and authority over its governance, and no faith-based organization will be excluded from receiving funding because leadership with, membership in, or employment by that organization is limited to persons who share its religious faith and practice. The guidance confirms further that the receipt of the loan will carry with it certain non-discrimination obligations, meaning as a recipient of those loans, the SBA is going to recognize your autonomy with respect to membership or employment decisions connected to your religious exercise, but it's going to insist that you not otherwise discriminate with regards to the goods or services or accommodations that you offer. The non-discrimination obligations will exist so long as you carry a balance on that loan. With all of that said, we would direct you to visit the SBA's website and their COVID-19 resources page as a starting point for anyone who's going to be applying. We'll put the website address up for you during the program, but you can easily find it if you don't have access to these materials by simply doing an internet search or Googling the Small Business Administration, and right on its front page, you're going to see right in front of you the COVID-19 resource page links. If you then look up the Paycheck Protection Program or the Economic Injury Disaster Loan Emergency Advances, you'll see they have separate pages set up for each of those programs. For those of you wondering where you can apply for the loans, it's going to be many of the same financial institutions with whom you are already doing business. If a bank is SBA approved, it can and should be participating in this program. Now, some banks are not, or some banks may indicate to you that they're not going to be able to accept your application. The SBA's website that we're already directing you to has a link where you can look up lenders who are participating in the Paycheck Protection Program loans in your area. You put in a zip code, it'll pop back several lending institutions. So you can use it as a resource to find somebody to work with on your loan. As you go down this path, we'd also recommend that you discuss this program with the bank or with your broker. You could pull a copy of the loan application directly from the SBA's site. We've directed you to that. And then you can use that application to start gathering the information that you're going to need for the application itself. Understand that the SBA lender that you're working with, their underwriting obligations or the type and kind of information that they're collecting is contoured and guided by that application. So whatever's in there is what they're going to be asking for you to provide. You'll likely want to assist or get the assistance or seek the assistance from your CPA or a financial or legal professional, some of whom might even be people that are within your congregation and can provide some help for you, or reach out to your outside professionals. And generally speaking, these applications are going to ask for a number of things. They're going to ask for simple things like your entity name, your address, your NAICS code, your tax ID. It's also going to ask for your number of employees. Now, we've heard lots of questions here from organizations asking whether they need to count themselves or count the employees of other affiliated faith-based organizations. And the answer there is not necessarily. As you'll see in the guidance that the SBA has put out, the SBA does have affiliation rules, which often require organizations that share common ownership or management or an identity of interest to count themselves together as one organization. However, the SBA recognizes exceptions for certain religious organizations. The guidance provides that if the connection between your organization and another entity would constitute an affiliation is based on a religious teaching or belief, or is otherwise part of the religious exercise itself, your organization qualifies for the exemption from the affiliation rules. For example, if your faith-based organization affiliates with another organization because your organization's religious beliefs about church authority or internal constitution, or because the legal, financial, other structural relationships between your organization and another organizations reflect an expression of your beliefs, your organization would qualify for the exemption. If, however, your faith-based organization is affiliated with other organizations solely for non-religious reasons, such as administrative convenience, then your organization would be subject to the affiliation rules. The SBA is not going to assess and will not permit participating lenders to assess the reasonableness of a faith-based organization's good faith determination that this exception applies. Now, the SBA has provided some guidance and encourages organizations that believe that they're exempt to apply for the loans and designate themselves as subject to that exemption. And they provide a model statement for you to use when applying. And we'll provide a link to that here and show you what that looks like. But again, if you're on the SBA's program site and you find the faith-based frequently asked questions around the CARES Act, you'll see as attachment A to that guidance, a copy of the statement that you would want to provide with your loan application to state that you believe that you're exempt from the affiliation rules. Beyond that, staying on the subject of your employees or the number of employees, your employee headcount would not include independent contractors, and those might be ministers or clergy persons working with your organization. You're also going to need to have payroll reports for a 12-month period ending on your most recent payroll date. For most of you, that's going to be April 1st through March 31st, April 1st of 2019 through March 31st of 2020. The payroll reports should show gross wages for each employee, including officers if they're paid wages, paid time off benefits, vacation pay, medical leave pay for each employee, and then also the state and local taxes that are assessed on each employee's compensation. Again, remember when you're going to need this information, but when you actually go to compute the loan, it's going to be capped at that $100,000 mark for each individual employee. You're also going to need IRS quarterly 940, 941, or 944 payroll tax reports for that payroll period that we're talking about. You're also going to want to have your 1099s together for your independent contractors for 2019, not for services, but for 1099 for independent contractors that are working with you. You're also going to need documentation showing the total of the health insurance premiums that you're paying by the companies under a group health plan, include any payments made for employees and ownership. And you're also going to want to document the sum of all retirement plan funding that was paid by the company. On that point, do not include funding that came from employees out of their paychecks or their paycheck deferrals. Include all of the payments on behalf of all of the employees, including anyone that has ownership. Include 401k plans, simple IRAs, simplified employee pensions or SEP IRAs. All of those would be things you want to gather information on. For any of you that are submitting your own loan applications, you're going to need to provide your personal information, including your social security number, address, and verification of identity. The Paycheck Protection Program application is going to inquire about owners with greater than 20% ownership stakes. Generally speaking, for churches, you're going to be leaving that blank as there's no individual organization that owns more than 20% of the church, but you should each evaluate that question independently. And if you have questions, seek independent advice and counsel. As a last aside, beyond the paycheck protection loans, we wanted to address a question that we've received quite a bit of energy around, which is whether or not churches or employees of religious or faith-based organizations can take advantage of the unemployment benefits. And the short answer there is yes. The Pandemic Unemployment Assistance Program that we've already talked about announces funding for brand new unemployment benefit programs that are available to several categories of employees or workers that would not otherwise qualify for unemployment benefits. So we encourage all of you to reach out to your state employment development department for information about how your workers can apply for those new and unique state unemployment benefits to the extent that your states plug into that federal funding. So before we close off for today, I wanted to address a couple of questions that have already come in from folks as they were registering for the program, answer some of the really recurring themes, and then close out. But if you don't have your question answered while we're going through today, and we haven't addressed your question yet during the program, remember, we have the live chat feature going on at the side of the program there. Please float your question and we will try to address it on a live basis. The first question that I will take is from Kathy in Massachusetts. And she and others were talking about capital expenditures, infrastructure projects, improvements that were being made on church facilities or technology platforms and asking whether or not, if those projects are midstream and there's an economic downturn, can they use some of these loans to address those? I would first say with the Paycheck Protection Program loans, that's probably not going to be an admitted use of those programs. They're strictly limited to payroll expenses, along with mortgage, utility, and taxes. I'm not sure that those SBA loans would be matching up with things like buying computers or infrastructure sort of improvements like that. The emergency EIDLs, on the other hand, may qualify. I'd have a discussion with your lender about the EIDLs and see if they share the belief that that broader program can encapsulate those sort of expenditures. But the reality of it is those loans are not forgivable, so it may not be in your interest to take those out. You'll have to make those decisions for yourself. If you have capital available and that capital that would have been spent on infrastructure is going to have some pressure on it because you're otherwise going to be struggling to meet payroll and other things, recall, you can take the loan out to apply and pay for those payroll expenditures while using existing capital that was devoted to those infrastructure projects to keep them afloat too. So as long as the loan funding is being used to pay those payroll expenses, you can still go out and get those loans, pay those payroll expenses, and have that loan forgiven. So it's really just a matter of bookkeeping and record keeping and making sure that those loans are cleanly and clearly being used for those payroll expenses. Another question that we're getting, and this one, an example of it would come from the Glen Ridge Congregational Church in New Jersey, and that has to do with teachers. What do we do if we have teachers that are on our payroll? They're currently on our payroll. They would have been on our payroll through maybe May or June, but not into July and August. How do we structure that? Well, to begin with, in terms of looking at your payroll, remember there's a look back period. So when you're going to apply for the loan, figure out what your available loan amount would be, you're only going to be getting 2.5 times of your payroll. But if you're looking backwards and you show pay to those individuals, that average monthly pay would be reflected in those numbers, and you would have some amount that would be coming in a loan. Now, if you're taking it out and you're not actually going to use it because teachers would be taking the summers off anyways, you need to be careful of that. And I think this is a good question in terms of the financial planning behind it. You don't want to take out more than you're actually going to need. So be careful about that. If you take the money out and it's not used for payroll, or at least the guidance currently suggests now at least 75% of it's used for payroll, you're going to prejudice your ability to get that loan forgiveness. So that's a fair question. It's a good question. It's something that you really need to sketch out and do the math on to see if you only need a couple of weeks to carry you through the remainder of a school year or an educational year, and teachers would otherwise be off and not paid, factor that in. If the teachers would be off, but they're going to be paid throughout the year as salary, then it's no different than when they were continuing to be working. Just, again, take the loan out based on the payroll that you have in the past, what your monthly average is going to be, and then you would use those funds on a going forward basis to pay that payroll out over the 8 weeks following the loan origination. I got another question about interim staff or changes in what's happening at a congregation. The question here comes to me to one of planning and some of the math that goes into this. Now, if you had somebody serving in a role like that in the past, and if you look back during the prior year and you see that salary on the books, that person's anticipated or typical salary will be factored into your monthly payroll cost, and you can get that amount built into your loan, assuming that you're expecting to hire somebody in fairly quickly. If you've had an absence for quite some time, that amount of salary is not going to be having been paid out. It's not going to be factored into your monthly salary cost. You're not going to be able to get that as part of your PPL loan. And so if you were to hire somebody tomorrow, understand that there would be a shortfall there in terms of the loan amount available to pay that. Now, on the other hand, if you had somebody in that position, you could get the money through the PPL program, but you're not really anticipating that you're going to fill that role in the 8 weeks following loan origination. A fair question to be asking yourself is, do you really want to take that much out? Because you may not really have the expenditure on the back end to make and you want to make sure that you're at least hitting that 75% expenditure of loan proceeds on payroll. So maybe you don't take that fund out. So if you have some changes, particularly in management level folks or ministerial level folks who might be earning decent salaries, think about whether you can get their funding in the first place, or if you really want to take it out because you're really going to need it down the road. Let's take one last one that I saw quite a bit. And that one would be echoed by the folks at the Good Shepherd Lutheran Church in Wisconsin. And that is, Dean, what does it mean to be necessary? Now, these loans are going to require some level of certification when you go through the loan process. You're going to have to certify that you're qualified. You're going to have to certify that you anticipate using these paycheck protection loans for payroll, mortgage, utilities, those sort of things. You're also going to have to certify that current economic uncertainty makes the loan request necessary. So even if you have enough cash on hand to cover this month, if what's happening around you is creating uncertainty as to what's going to happen in the coming weeks while this loan is funding, and you're not necessarily sure you'll be able to meet those payroll demands, that suggests that you will be able to certify truthfully on your loan application that the current economic uncertainty makes it necessary for you to take out these loans. You do not have to show, at least in terms of the wording of the act or the interim rules, that you're already upside down and you can't meet your current payroll obligations. So that's a final question that we've seen quite a bit of and we wanted to address. With that, we will close off today's programming. Now, I understand we're throwing a lot of information at you. This program itself and all of its 800 pages of political language and text is confusing. And these are some trying times to try to digest all of this stuff as quickly as you're being asked to do. So by all means, if you have questions, please pose them. Use the discussion bar to the right, and we'll stay online for a couple of minutes after the program to try to answer as many questions as we can. If there are questions about the CARES Act, these programs, or any of the other programs that you're seeing rolled out by the federal governments or the state governments in response to the COVID-19 pandemic, please reach out to the insurance board. They're there for its members. They want to be responsive to your needs, and they can deliver additional programming or provide you additional information through their many resources and the many consultants and advisors that they plug into for their members. With all of that said, I wish all of you the best to stay safe and healthy in the days that come. And again, encourage you to reach out to the insurance board or the professional consultants that you work with to get more information about these very important programs. Thank you.